another big fund with inflows this year that you guys are running, JPMorgan Equity Premium Income ETF. This is another one of those sort of mixed funds here. You want to own stocks in the S&P 500, but it's low volatility, and you get an income kicker. And I'm right reading this 12% dividend?
Yeah,
right?
that's right.
So you get these mixed funds now that try to get an income kicker on it. Explain how this works. First, you're in the lower volatility end, right? So you're looking at consumer staples names. You're looking at AbbVie, Hershey, Progressive, Bristol Myers, Pepsi is what you own in here. So it's there you go. And there's Exxon thrown in. Yeah. And you also have the dollar thrown in there. But where do you get this 12% dividend?
Yeah, so I'd sum up the holdings that you just rattled off as quality balance sheets, right? We want quality balance sheets in this day and age. And so we own those names. A lot of those pay dividends, and so that starts to contribute to part of the income. And then it's actively managed by a portfolio manager by the name of Hamilton Reiner. He's been doing this for decades, and he's writing 1 month out of the money calls. And we're collecting premium on that, so that comes into the fund in the way of additional distribution. So you've got the dividend income and then the premium income from those options put together. Right now, it's yielding that 12% that you quoted.
Because the names you're talking about here, the consumer staples names, they're usually 2 to 3% typically. Yeah. That's a long way from 12% dividend yield here.
Yeah, well, but remember, the premium that comes from those options is dictated by the volatility in the market. Yeah. And if you look at this year, we've had volatility, and so that's pushed that premium up. And therefore, we've been able to harvest that 12%. Historically, we target about a 6 to 8% yield on this portfolio, 6 to 8%. Yeah. But because of the increased volatility this year, we're pushing 12.
So, Tom, this sounds like my God, how do I sign up for this? I got low volatility stocks, I got the S&P, I'm in equities, and I'm getting a 12% dividend yield. What could go wrong here? How could this whole thing change? It sounds kind of magical, doesn't it?
It does. It sounds like 60-40 is no longer on life support, right, Bob? I mean, the markets have come back in a decent way where there's good quality stocks with decent dividends. And now that we've taken our medicine on the fixed income side, we're also in a great situation where we can get some decent yields. So again, things are a little bit rosier today. A quick shout out, Bob. I loved your book party last week at the New York Stock Exchange. Again, congratulations. All your friends in the industry turned out. It was a great time.
Well, thank you. It's 2.5 years in the making, and it was 175 people came, and it was half the guys on the floor meant a lot to me. I've been 25 years on the floor of the New York Stock Exchange, and after a while, you wonder, what exactly have you learned working down here? So that's what the book is about. Anyone who's interested, shut up and keep talking. Lessons on life and investing from the floor of the New York Stock Exchange. I wasn't planning on a plug, but Tom's very good at that. He's very good at transitioning into these easy plugs. Thank you, Tom.
You deserve it.
Thank you. What's the criteria for inclusion here? So again, I get back to this miracle, this 12% dividend with all of these nice, safe stocks that you own. Where could this kind of go wrong? If all of a sudden the volatility is lower, you're not going to collect as much premium, right?
That's exactly right. And you're asking the perfect question that I encourage all investors to ask is what could go wrong, right? And so exactly that, the volatility could come down, and therefore we'd be collecting slightly less premium, and that yield would come down along with that. We are, writing covered calls here, so we are giving up some of the upside on this one. If we go into a straight up market from here,
you're going to have to
leave a little bit on the
call,
table.
right?
That's exactly right. We're going to get a call. That's exactly right. Now, the fact of the matter is that hasn't happened this year. We know that the primary benchmarks are down 20, 25, 30% in some instances, and JEPI is down 7%. It's an equity portfolio, and so that option premium also plays another role, which is it provides downside protection. And so, investors are saying, okay, I don't want to get completely out of equities. I know that's an important part of my portfolio. Maybe I'll own this portfolio where I can harvest some income. It provides a little bit of downside protection, and that allows me to navigate these tricky markets as well.
So what's the overall, if you had to describe where you're seeing flows, your client flows, you're at JPMorgan, they've got a pretty significant business. What are they, am I hitting the theme right here? Short-term duration is sort of the big overall theme for investors?
You're hitting it right. So first of all, bull market, bear market, investors are always looking for income, right? That's always something that we see, that's perpetual. So number one, if you've got income, that's something that investors are continually looking for. Number two, when we've got this rising rate environment, you know that if you've got duration, you've got some duration risk. And so you want to pull that risk in. And now that we've talked about that the Fed has hit these new levels on rates, you're actually able to get something for that as well. And so absolutely, investors are bringing that duration in and doing it in that way. And then thirdly, you know, with JEPI and JEPIC, its cousin, which is on a growthier basket of names, they're saying, okay, hey, maybe I can get a little bit of upside here, and particularly in a range-bound market.
Tom, VettaFi is essentially an educational marketplace for investment advisors. What are the RIAs telling you they want to hear? I mean, this must be tough for them. They've got clients. They're using ETFs, stocks down, bonds down double digits, and their clients have got to be asking them what exactly they should be doing. What do they want to hear from you?
So the number one fear that they've had for the last 2 years is inflation. Talking to their clients about inflation, as now we're in the fourth quarter, how do you battle that? And as we continue to see rising rates, the good news, Bob, is we've got valuations in stocks that are really at fair levels. And when you look at areas overseas, especially in emerging markets, it may be generational buying opportunities. And on the fixed income side, kind of what we've been tackling here, yields are back. And yields are back to a level that are very attractive, especially for those in retirement or have retirement portfolios. So, hey, we took some medicine for the period of time that we're in. It doesn't mean that inflation's away. The Fed's trying to do its job. But also, there's a lot of tools out there, kind of like we've been talking about today, to fight inflation as well. So things are much better than they've been in the last year and a half. And with all the ETF tools that are available, advisors are getting creative, but still concerned about inflation, number one.
Yeah. You know, it's interesting because we're acting like we could perfectly time the markets, in fact, but we all know that it doesn't work that way. Market timing generally doesn't work. And the most important thing is to have a long-term plan. And perhaps we all were a little too much invested in stocks over bonds, and there are now attractive alternatives. So maybe some reallocation is appropriate, but I want to keep pointing out to most people that my old disciple, I'm a disciple of Jack Bogle, he always used to say, don't just do something, stand there. Sometimes it's better to do nothing. So I don't think anybody here is trying to advocate that we start trading around all of this chaos. It's a very difficult situation.
Right. I think it's an important time for investors to go back to what's my North Star? What am I trying to accomplish with my portfolio? And am I aligned to the outcome that I'm looking for? I think one interesting thing with rates up is that the whole free money thing with rates at 0% has brought a tremendous amount of discipline into portfolios, and companies are having to run in a much more disciplined way right now. And so, again, we're not market timing here, but you know, I think a lot of investors are dramatically underweight value. They might have gotten a little overweight growth over the last couple of years, and so thinking about maybe value. And I saw you guys showed the chart on Java a little bit earlier, which is our actively managed value fund, outperforming its benchmark, the Russell 1000 value, by 6%.
Well, you know, the good thing about owning the S&P 500 is right now, of course, growth has become such a bigger part. Look what happened to energy, which is a classic value sector, for the most part. 3% of the S&P at one point. Now it's 5% of the S&P.
But I mean, if we look at all the tech earnings from last week, there's a lot of misses, and those had started to become some of the bigger names within the benchmark. And so it's interesting that these other ones are starting to crop it up.
The issue is a revaluation of growth finally happening. The value guys have been waiting a long time for that to happen. We'll see, but you can definitely see one of the reasons the earnings growth numbers for big cap tech are definitely coming down. Yeah. And they're holding steady for some other sectors. Energy, industrials, holding pretty good.
Yeah, and these companies have physical things, right? Like they have oil wells, they have trucks that ship the oil. Like they have actually things on the balance sheet that generate this income.
Tech companies have intellectual property. They have software.
That's right.
That's important.